Hello, everyone. It's been a very tough month since we last gave this webinar, but I wanted to, first of all, thank you very much for your support. ARK is net inflowing this year, and I think it's because we give away our research, and our research is unique. It's original research, and we are trying to help people understand how the world is going to change during the next 5 to 10 years and how rapidly it's going to change. And I believe that our comparison to the NASDAQ 100 has also helped. The NASDAQ 100, according to our estimates, is exposed to truly disruptive innovation to the tune of about 25%. The rest of it is names you know very well: the FANGs, Microsoft, NVIDIA, and the sundry food and rail and trucker companies. ARK, as you know, is focused solely on truly disruptive innovation, and most of our stocks are not in broad-based benchmarks. And I believe people who are reading our research, advisors, investors, are beginning to understand that they don't have enough exposure to those companies and those stocks that are going to cause transformations in the way the world works. So we thank you for your support. This has been a very difficult time for everyone. As you know, we've always considered ourselves the closest you'll find to a venture capital fund in the public equity markets. And as we all know, venture capital funds have a 5 to 10 year investment time horizon. Our investment time horizon is 5 years. And we couldn't be more optimistic about how these new technologies are evolving. And the reason they're evolving more quickly than we anticipated is because we have many more problems than we anticipated. I certainly didn't anticipate the magnitude and length of time that we'd be facing supply chain issues. And I certainly didn't anticipate Russia's invasion of Ukraine. So we have many more problems that innovation will help to solve. So just wanted to start with that note. Before I go into monetary policy, fiscal policy, economic indicators, and market indicators, and end with a little bit more on innovation, I'd like to compare what we've been through the last year or so to what we went through right before COVID. So from February 20th to March 20th, our portfolios, our strategies, the performance, they were cut in half nearly. And it was in 1 month span as we thought the world was going to shut down, and we wondered about a depression and a collapse in many other ways. And at that time, we began to analyze the economy, or scrutinize every economic indicator that came out for clues as to what really was going to happen. How successful would the stimulus policies be? And as you know, we started this webinar series or YouTube series. At that time, every week we were trying to reassure people that, especially investors, that the world was not ending, that it did seem as though the global stimulus measures were going to work. And we also at that time started our mantra: innovation solves problems. The coronavirus crisis created a lot of problems, and innovation, whether it was in the genomic space, testing, vaccines, or in the work space, the hybrid, actually the remote work and now hybrid work, these were solving the problems of that day, and they're continuing. These are trends that have been unleashed and are unstoppable now. So now we are a year into a similar time period. The performance of innovation-based portfolios has been crucified, even though the number of problems that have cropped up in the last year have given innovation even more opportunity to perform. Now, because we did so well coming out of COVID, again, our companies were really helping to solve problems. We have faced in the last year the so-called comparison issue. Now, we have a 5-year investment time horizon, so we're not looking at year-to-year comparisons. Nonetheless, the markets got caught up in, oh dear, how much slower is it going to get? And so we've been grappling with the consensus Wall Street expectations year over year, and their worries that growth rates would continue to slow down into negative territory, much like they did during or in the aftermath of the tech and telecom bubble. We couldn't be further away from the tech and telecom bubble. The innovation that was accelerated during COVID is continuing apace, and I will go into in a moment what our expectations are for revenue and margin growth during the next few years. What are some of these problems? Well, we see labor shortages still, and in fact, we're beginning to see labor hoarding. We see companies now taking on labor when GDP has gone negative. They went through such a difficult period that they decided, oh heck, I'm able to get this person now. Even though my business is slowing down, I want to make sure that I never go through that again. So I think we're seeing labor hoarding, much the way we saw inventory building when manufacturers and retailers couldn't get the supplies they needed as consumption of goods, non-durables and durables, took off during the coronavirus. And so I think for both reasons, we're seeing a margin squeeze broadly in the economy, and we will continue to see margins going down. Well, innovation solves those problems. You can automate more to solve for labor shortages, automate more to solve for inefficient processes. Robotic process automation is really evolving very, very quickly. We're seeing supply chain issues because of China's now zero COVID tolerance. They came on very strongly this week, saying that was Xi Jinping's top priority. And they did not mention growth in the economy as another priority. So they seem to have toughened their stance. So these supply chain issues will probably continue. And we believe that automation and workarounds, thanks to technology, are going to help there as well. We see, because of Russia's invasion of Ukraine, food prices soaring, energy prices soaring. Well, electric vehicles are, we believe, starting to take the edge off of that. There's been an accelerated shift in consumer preferences towards electric vehicles. And so that we believe longer term will pull energy prices back down. I know I've been on record saying that energy prices are going to plummet back down to where they were in the 70s, we believe, longer term, because the move towards electric mobility is unstoppable, and it is now happening at an accelerated rate. In terms of food prices going up, well, Ukraine is the breadbasket of Europe. And so we have to use genomic methods, gene editing in particular, to be able to plant in less fertile areas. And that work is underway and proliferating as well. So what I'd like to do is talk a little bit about what has happened in this last year, and especially in the last 2 quarters. The risk-off period that higher interest rates and inflation have caused has forced investors who have been risk-off, don't have as much tolerance for risk as they once did, to diversify back to their benchmarks. That they have done, we believe, And in so doing, they have sold our stocks. Our stocks are not in benchmarks, with the exception of Tesla in any great measure. And as you'll notice, Tesla has held up much better than other of our innovation stocks. It's because it was put into the S&P 500 and other indices in recent years. Actually, S&P was in late 2020, and since then it has held up better. So we believe that our technology holdings are the technology and innovation holdings that will serve the future. And in contrast, the S&P 500's exposure to technology is 28% of that index. We don't own any of those stocks. We do not think that technology stocks in the S&P 500 are going to participate in the true transformation of the global economy in the next 5 to 10 years. What has happened also, algorithms and quantitative research directors and analysts understand that this is what happens during risk-off periods, and so they have helped to exacerbate it with their algorithms. So what we're going to do to help people understand what is truly going on out there and how the world is going to look, not how it has looked, which is what the benchmarks are all about, we're going to publish a paper which addresses head-on the criticism that ARK's portfolios and the companies in the portfolios are really just a repeat of what happened during the tech and telecom bubble, which, as we know, did not end well. Well, that is how those algorithms and quantitative experts have been treating our strategy. And the similarity in terms of footprint to NASDAQ 100 circa 2000 is quite similar. So we want to establish now how different the fundamentals of our companies are relative to those that were birthed during the tech and telecom bubble. Those were seeds, and many of the seeds failed. If you look at the NASDAQ, they won't even publish what their holdings were in 2000, 2001, or 2002, or 2003. We tried to get hold of those companies. They won't show them because so many failed. So we had to resort to NASDAQ 100. And of course, there's survivorship bias there. The largest companies had a much better chance of survival. Nonetheless, with the NASDAQ 100, what we have discovered is that the revenue growth of the companies in the NASDAQ 100 peaked around 99, 2000, and then moved into negative territory by 2003. Now, if you look at our companies, we are seeing revenue growth, even if you use consensus estimates, not ARK's, consensus estimates, the same analysts who are recommending whether or not to allocate more to benchmark related stocks or our kind of stock, they are suggesting, or their estimate for the next 2 years for our revenue growth, the revenue growth of companies in our portfolio, is in the 25 to 30% range. Now, our expectations are higher than that, but that is that's a long way away from negative. That's the first thing. The second is, if you look at the gross margin structure of the companies in the NASDAQ 100 circa 2000, you'll find that the peak in the gross margins back then, and gross margins are a really good, give us a good idea of what underlying profitability is and will be. So gross margins slipped from the high 50% range, to the high 40% range as revenue growth was declining. The consensus view for the stocks in our portfolio for the next few years is that our gross margins will move from the mid-50s into the high 50s. And our expectations are that they will be closer to the high 60s. So very, very, very different time compared to the tech and telecom bust. Our revenue growth remains robust. Our gross margin structure is increasing. And in fact, if you do compare the lines at the similar point during the tech and telecom correction, you'll find that our margins have moved above, just moved above those margins. Many people criticize our portfolios for the lack of earnings, and many of our companies have very fine earnings, but many companies, including those with fine earnings, are investing aggressively now in sales and marketing and R&D to make sure they capitalize on some of the biggest opportunities of our investment lifetimes. Now, I've been around in the business for 45 years, and I've never seen the opportunities I see now. According to our expectations, truly disruptive innovation, which right now is valued in the global public equity markets at roughly $10 trillion, roughly 10% of the global equity market cap. We believe that 10 trillion is going to scale to 210 trillion by the year 2030. And if you want to see the building blocks that make up that analysis, take a look at our Big Ideas 2022, where we size the opportunities that are evolving thanks to genomic sequencing, robotics, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. The paper that I just referenced, we are going to be putting on our funds website sometime within the next 2 weeks. So we invite you to take a look at that. Night and day compared to the tech and telecom bubble. Okay, now on to, and I might add, the valuations of our companies now, if you look at them from many different angles, are below those of the NASDAQ. And as I just mentioned, we do not believe that the NASDAQ, certainly not the NASDAQ 100, includes nearly enough disruptive innovation opportunities as our strategies do. Okay, now we'll go to monetary policy, fiscal policy, economics, market indicators, and a little bit more about innovation. Monetary policy. The Fed raised interest rates 50 basis points this week. And I had been saying that I thought that would be a mistake. The markets are corroborating that it seems that the Fed is making a mistake. So we've seen the stock market go through a spasm. The S&P now, from its peak, is down 15%. The NASDAQ, from its peak, is down 25%. Pure play innovation strategies like ours are down 60 to 75%. So that's not just a spasm, that's a convulsion. And you'd think that innovation companies that are not in benchmarks are witnessing the end of their world. It couldn't be further from the truth. This is a huge inefficiency in the market, this tendency to move towards benchmarks in risk-off environments. It's ridiculous that the genomic revolution and blockchain technology and crypto assets are all behaving exactly alike. In fact, crypto assets began to correlate highly with the NASDAQ starting at the beginning of COVID. Before that, there was no correlation at all. And so we think this is an anomaly, a massive anomaly, and that with time it will correct and the efficiencies will be introduced back into the market. So that's the stock market. The bond market this year to date, if you use the 10-year Treasury yield and its proxies prior to 1940, year to date through April, and I'm sure even more so through today, the bond market has not seen worse performance since 1788. Think about that. This is like a tsunami and an earthquake together. I used to describe what was going on in the bond market as an earthquake, given the very low base of interest rates from which we started. Now, you might be asking why would that be true, given that the bond market was just a terrible place to invest in the 70s when inflation was taking off? Well, the difference between now and then is back then there were huge coupons. Interest rates they were paying were starting at 6, 7, 8, 9%. Whereas during COVID, we got down to 0.5%. So the base from which we're starting is very low. And that's why we now have a tsunami. The 10-year Treasury yield has gone this year from roughly 1.13% to 3.11. Again, huge percentage increase. High yield bonds, their spreads have increased, and now their spreads are relative to that Treasury yield. And so their spreads have gone up from 2.45 to 4.08. So in addition to the 200 basis points or the 2 percentage points that the underlying bond has gone up, they have gone up another 150 basis points. So credit is becoming much more expensive. If you look at credit default swaps, which are very sensitive to stresses and strains in the ecosystem, essentially they're insurance policies that investors take out or speculators take out to protect against some negative eventuality. Those have gone from, if you use the CDX, which is a market, MARKIT metric based on the 5-year credit default swaps, they have gone from 45 to 46 as of September 21 to 85, 86 as of today. Now, during COVID, they went up to 159. So we're not anywhere near there. During the fear that China was going to blow up in early 2016, they got to 128. Well, that's a little closer to 85, 86. But today, we are much closer to where we were in 2018, the fourth quarter. Now, what is the significance of that? In the fourth quarter of 2018, the market was beginning to send signals that the Fed was overdoing it by raising interest rates each quarter. And so this metric hit 95 then. So we're at 85, 86. So the Fed is beginning to understand that there are stresses and strains out there, and that is why this past Wednesday, the fear that the Fed would raise interest rates 75 basis points, either this go around or next go around, Chairman Powell put to rest and said they were not contemplating it. And so he was considered, he sent, relative to expectations, a positive signal. And all the markets seemed to enjoy a run for that one day based on the notion that the Fed was beginning to understand that maybe they're overdoing it. We think over the next month, now they have another meeting in June, over the next month, we believe that the Fed is going to get a lot of data. Today was one of those days with the employment report that is going to put another measure of caution into their cadence here. So we would be surprised to see another 50 basis point move. Maybe they do 25. We still think they're overdoing it and the markets won't be happy. But I think what's happening here is this Fed and the members of the Fed are so afraid that they will be stuck with the legacy of reigniting inflation and not being able to put the genie back in the bottle. They're so afraid of that they are they're speaking very fiercely right now, and they've made a bold move, 50 basis points, when the base is only 25 basis points. So we shall see. We've seen M2's growth decelerate from 27% to 9.9%. And if you look at it that's on a year-over-year basis. If you look at it on a 3-month moving average basis and annualize that, we're in the low single digits. And it's kind of consistent with what happened in the GDP report. I'll get into that in a moment, but that GDP report was negative. Fiscal policy. All right. On a year-over-year basis, spending is down 20%. This is another big break on the economy. We've gone from, monetary stimulus and fiscal policy stimulus to restraint on both, and that's very sudden within a year's time. And of course, we are comparing against the stimulus payments last year, so it's not surprising. We wouldn't expect to continue those, but nonetheless, that is a break compared to where we were. And I think the odds of any tax package going through or Build Back Better going through is very low. We're in midterm elections. Things are not going well generally for the economy, gas prices, foreign policy, Russian-Ukraine war, and so forth. So I don't think that anyone who's going to be a part of the midterm elections will want to participate in controversies around any of those. Last month on YouTube, I gave 2 points of view. Same. Everyone's looking at the same numbers, but there were 2 points of view that were very different from one another. One was the economy's charging ahead, inflation's going to continue, rates will continue to go up, we don't think there'll be a recession, and so forth. And then the other one is, whoa, watch out, inventories are building, consumption is slowing down, consumer sentiment is falling apart. We risk a recession here. And oh, by the way, China and Europe are in recession. Well, I think that the first camp is capitulating to the second camp. It's still fighting this notion that GDP actually fell. This in real terms now. Take away inflation. GDP unit growth fell quarter to quarter at an annual rate by 1.4%. The consumption of goods slipped slightly. That's what we're expecting. Meanwhile, inventories are piling up. Government spending went down, as I mentioned. Imports surged. And so a lot of those economists and strategists in the first camp were saying, oh, that's exogenous. That's an anomaly. You've got to adjust for that. No, you don't. Imports surged and went straight into inventories. They canceled each other out. So you don't. So what's so fascinating about the world of economic experts today, some were trained in economics, to be sure. Many were not. They were trained. They learned after they got their MBAs. And maybe they didn't go into the depth that many of us had to back in the day when everybody came into this business with an economics degree. So there's a lot of superficial analysis out there. and a lot of cherry picking also in terms of indicators. So we do think that a recession is quite possible here in the United States. A recession is defined as 2 consecutive quarters of declines in GDP. We've had one, and I wouldn't be surprised to see another either in the second quarter or the third. So technically, we would, if we were positive in the second and went negative again in the third, that's not a technical recession. But in my book, it's close enough. You know, real average hourly earnings have been falling since April of 21 on a year-over-year basis. They were down 3.4% in April of 21. They're still down 2.6%, but there's been a consistent decline over the past year. And I think those in the high inflation camp expected wage growth to continue accelerating. That is not happening, and I think that I think that's the linchpin of those who think that inflation is out of control and is only going to get worse. So we're paying we're paying a lot of attention to the wages. Speaking of which, today was Employment Friday, and the report was pretty much in line. I won't go through all the details, but there were, meaning it was a good report. We're still growing employment at a roughly 400,000 per month clip. I have a suspicion that we're seeing some hoarding in those numbers, and we're getting a clue that we may be nearing the end of employment increases, at least strong ones. The household employment gauge, household employment, it's also known as establishment employment, it declined 353,000, while non-farm payroll employment increased almost 400,000. The reason I pay a lot of attention to household is because it's a leading indicator of the headline non-farm payroll. And there are a lot more small businesses in it. We also saw Manpower suggest that employment was weakening. The Beige Book, which is a Fed publication, said it was fraying at the edges. The National Federation of Independent Business, again, smaller businesses, employment went down. And even Evercore ISI's CFA survey is saying that employment gains are coming down, are not as rapid as they once were. We're getting the Challenger survey, I think for the first time, it is the first time since COVID started, the Challenger layoff survey showed an increase year over year. And they tend to measure layoffs that are sort of headline layoffs. They're bigger than just one-offs. Amazon, in its quarterly report, said, we overhired. We have too many employees now. We're seeing mortgage companies laying off people. You saw the Zillow report last night saying housing's coming off the boil. Affordability is a real problem. Now, the other data point of note was average hourly earnings. So average hourly earnings, this is what I was mentioning just a bit ago, are a good gauge of wage gains. Now, we know that the shortages in labor have been at the lower income end of the range. They're across the board, but leisure, hospitality has had a very difficult time finding people, and they have been bidding up wages. In this report, average hourly earnings were up only 0.3%. And if you look at the last, that would be 5.5% on a year-over-year basis, a tick down from 5.6%. And if you look at the last 3 months, you'll see the 3-month moving average percentage change, annualized, of this measure of wages is up 3.6%. So we're coming down from that 5.5% year over year. And if we continue to show 0.3% or lower, I think we're going to see some real head fakes. A lot of people are expecting wages to go up and to the right, wage acceleration in the rate of change. Okay, now I know you've been bombarded by headlines about inflation, and we are not ignoring them. Did we expect supply chain issues, the magnitude of what we've seen, or zero COVID policy in China, or Russia's invasion of Ukraine? Absolutely not. Have we been wrong on how quickly inflation would dissipate? Absolutely. For those reasons, we believe. So let's just face the music. PPI inflation up 11.2% year over year. CPI up 8.5%. Personal consumption deflator up 5.2%. And the metric that the Fed pays the most attention to is core PCE deflator, core personal consumption expenditures deflator. So that's excluding food and energy, which they consider to be very volatile, more volatile than the underlying. Core inflation is 5.2%. Now, if you've listened to that, what you're probably thinking is, whoops, input prices are rising faster than output prices. The PPI is rising faster than the CPI and the PCE deflator. What does that mean? That means margin degradation, probably. So disappointing profits for companies that are not controlling their expenses, perhaps by using more automation and increasing productivity. Again, innovation solves problems. This is going to become a big problem. And we think that the adoption of innovative strategies to lower costs and sustain margins is going to become another mantra. Innovation solves problems. If you look at the personal consumption deflator, that too was up only 0.3% last month, which makes the second consecutive month it was up 0.3%. And expectations are that the next month will be up 0.3%. So here again, we have an annualized rate of about 3.5%, well below where we are now on the year-over-year basis. Now, what really shocked the markets this week was the productivity report. Productivity plummeted. Unit labor costs quarter to quarter at an annual rate. This is not year over year. This is quarter to quarter, annualized rate, up 11.6%. This is what's telling you we're going to see margin compression in corporate America. Now, the quarter before, it was 1%. So that's unit labor costs. The quarter before didn't seem to be a problem. Productivity was overtaking a lot of the wage, absorbing a lot of the wage growth. That was not true this last quarter. And it gets back to this idea that maybe we're hoarding labor. Maybe we're hoarding labor. And if we are, I have a feeling that margin compression will cause a disgorgement and an increase in the unemployment rate. The unemployment rate was 3.6% this last month. Didn't change from last month. But I have a feeling the puzzle we're putting together means that it will go up. Now, some more evidence that inflation is receding here already. If you look at used car prices, this was a leading indicator during the COVID crisis of how high inflation would go and how rapidly it would increase. At one point, used car prices were up 60% versus their pre-COVID level. Well, used car prices have been falling for 3 months now. They're now up 14% year over year, but I think at their peak on a year over year basis, they were up in the mid-40s. That 60% number was versus the pre-COVID level. So we've come down in used car price inflation from the mid-40s down to about 14%. And at the same time, one of the reasons is sales of used cars over a 1-month period dropped by 13%. And the Manheim Used Car Index folks, the people who put that together, remarked that this was highly unusual at this time because tax refunds usually cause an increase. So down 13%. And on a year-over-year basis, that takes used car sales down by 21%. New car sales are down 22% on a year-over-year basis. Car prices at one point, used and new, accounted for 1/3 of the increase in the inflation rate, and now they're reversing. So that's very important. I also want to point out that oil prices peaked in the 130s per barrel in March, and they're down to 110. Now, so that means they're down pretty significantly month to month. I don't know exactly the survey dates, what those prices were on those dates, but energy prices were the other reason behind the supercharged inflation rate we've seen. And now they're starting to come down. Now, if Russia-Ukraine gets worse, maybe we have a problem. If Europe basically says to Russia, we're not taking any more of your oil, maybe we have another shock. But I've actually been surprised. I would have expected more follow-through after that 130, given how serious this invasion has been. One of the reasons it probably hasn't happened is China. I think China's in recession. Europe's in recession. U.S. had a negative GDP quarter. There's demand destruction as people start substituting scooters and bikes and motorcycles for cars. So oil is no longer the propellant to inflation, at least not yet. And even wheat, food prices up a lot. And again, early March seemed to peak wheat, and it's down 5% in the last month. So maybe coming off the boil here, we shall see. And even in the technology space, we keep track of GPUs, semiconductors, and used in gaming and crypto. And on the secondary market, there was big speculation, there were shortages. Those have come off from 1,500, I think this is for the RTX GPU, NVIDIA's, have come off from 1,500 to 700. So they've been cut by more than half. So that's also quite interesting. Chairman Powell said that inflation might have peaked in March. And so you can see some of the reasons he said that. And it's a good thing that he's thinking that, because we believe that the rate of interest rate increases right now is onerous for the economy. And I don't believe that 1.4% drop in GDP, even before this 50% rate hike, was a fluke. I think it's sending a real message to the Fed, as are some of these pricing indicators. Okay, we'll summarize the market indicators. We've done that to some extent already, and then turn back to innovation for a moment. So we've gone through what's happened to the various averages, broad-based averages out there. If you look at the S&P 500 year to date, energy is the only sector that's up. It's up 47%. So if you didn't own energy, and we don't, we think over the next 5 years, the energy unwind is going to be pretty severe. But it's up 47%. So utilities were essentially flat, down a little bit. Staples as well, down just a little bit. On the other side, you have communication services. So, some of the beloved stocks in the broad-based benchmarks. So Facebook, Netflix, Amazon, the comm services down 25%, although I think Amazon's in consumer discretionary, which is down 24%. and technology broadly is down 20%. As I mentioned, we do not own the technology stocks in the S&P 500. Would we have done better if we did? Yes. But we don't think they are the leaders of the future. And we're all about how the world is going to change. And we're looking for those exponential growth trajectories that will happen along the way. I mentioned in terms of bonds, I'll just reiterate that if you look at credit default swaps, the Fed's getting a message like it did in 2018. Watch out, watch out. Commodity prices, they look like they're in a topping formation. And one of the reasons they are is the dollar has been on a run. It's up over 15% since its low last year. That is a huge move, and it's not just against emerging market currencies. They're doing worse. It's against the euro and the pound and the yen especially. I've been shocked at the yen. It's gone from 105 to the dollar to about 130 to the dollar in the span of a year. That's huge. And it's making our goods more expensive to the rest of the world. So our export growth is probably going to slow down, not only because many countries are in recession, but also because our prices have gone up so much to them, given their currency declines. And as I mentioned, crypto, new asset class, should not look like the NASDAQ, but it does. It's highly correlated right now. You know you're in a bear market and maybe close to the end when everything starts acting alike. And we're seeing the capitulation of one market after the other. I think the Fed's going to get the message. The final thing I'll leave you with is Simon Barnett, one of our 3 genomic revolution analysts, will be with me next YouTube to talk a little bit about the genomic revolution and how they've been compiling statistics, a little bit like what we've done comparing all of our strategies, revenue and gross margin dynamics, to the tech and telecom bust. They're doing the same just for the genomics revolution. And they are seeing, now that the tough comps are soon to be behind us, we're cycling through them, they're seeing a reacceleration in revenue growth from pretty hefty levels already, and margin expansion. And I think I've heard in this earnings season, Simon say, this is much better than I thought it was going to be, much sooner. This trend is happening faster. And again, I'll go back to, as I hope I'm not boring you with it, but innovation does solve problems. And it is not being rewarded in the market right now. It's rewarded in the private markets. We have seen some down rounds. Many of those have been in more Me Too companies that are not involved in the truly disruptive innovation space. Given the route in the public equity markets when it comes to innovation, we'll probably see some more down rounds or pushing out of funding until the public markets become more rational. We do not believe the public markets are rational right now. The selling has been indiscriminate. Certain ilk of stock that algorithms and quants think do not belong or will not perform well in the next day or week or month. That's not what we do. We're focused on a 5-year investment time horizon. I would ask you to tune into our market update next Tuesday if you'd like to hear our analysts talk about their companies and stocks. And I think when you listen to them and when you read our research, which we freely give away, or if you tune into our analysts on Twitter, you'll see the kinds of conversations they're having with experts deep in the bowels of companies that are at the forefront of innovation. And you'll see how sophisticated those discussions are. You'll see how profound those discussions are in terms of how they're going to change the way we work and live, and how much better they're going to make the world. So given the dreariness in the equity markets and the bond markets today, and now increasingly the commodities markets and crypto, take a look at our research, read our Twitter profiles for some hope and optimism, because I can't tell you how excited and confident we are that our platforms are going to transform the world and are entering exponential growth trajectories now. This is not about 5 years from now. We are now living the reality that was only a dream in the tech and telecom bubble. That was a dream, and you had investors piling into the dream. Today is the reality, and they're running away from it. They're running for the hills, running for their benchmarks. The decisions in the tech and telecom bubble ended badly. The decisions, those running away from innovation right now, we believe those decisions will end badly as well. So again, read our research for hope, optimism, and really a thrilling look at what the future is going to hold. Thank you so much.